Remuneration, responsibilities, risk and returns. Those are the 4 R's that the 5 must-ask questions before hiring a financial advisor fall under as categories. Hi, my name is Christoph Enslin, and in this video I'm going to expound on these 5 must-ask questions that you need to ask any financial advisor that you are wanting to hire. Let's dive right into it. The first R, remuneration, holds the first 2 questions. How are you paid? And how exactly are your fees calculated? Then your role and responsibility. Are you a fiduciary? And then the third and the fourth R are risk and return. What kind of returns have you produced with what risk? And have you done this with real money or just in a model portfolio? Let's dive into details. How are you paid? Are you paid by commissions? Are you paid by fees or other things like kickbacks? Here it is important that you are looking to align the payment incentives with your own goals. Just ask yourself the question, how do you establish alignment of interests? If your financial advisor is paid by commissions, he or she will be incentivized to sell you financial instruments that pay him or her the most in terms of commission. That's not necessarily the best product, is it? Only you, the client, should be paying the advisor. We're talking about a fee-only advisor that you should be looking for. Some advisors call themselves fee-based versus fee-only. Fee-based can mean I'll charge you a fee, let's say 0.5% or 1% or a fixed amount of money, but then maybe in addition to that, the advisor will get some commission, some kickback or something like that. Versus fee-only, advisors that really only get your fee and they don't take any other commissions, any other kickbacks or sponsorship monies, so that they are really on your side and have as little as possible conflicts of interest. That brings us to the second question. How exactly are the fees calculated of the advisor? They could be flat fees, they could be fixed dollar fees, one-off or as a subscription. There are hourly fees, and there is the percentage of the value of the assets under management. Let's look into these 3. Again, we're looking for alignment of interests, right? An hourly fee, I'll pick out the middle one, may be appropriate if your situation is very complex. Then the hourly fee is totally fine. But for most people's situation, a flat or also known as fixed dollar fee will be more appropriate. And basically, like in any other profession, you get a certain service for a certain fee. It makes total sense. Now, flat fee could be, for example, $400 for creating a plan how to get out of debt, or $800 for consolidating all our retirement accounts into one and bring it into a coherent strategy. Those are examples from my work that I do. It's one-off work and the client can run with it by him or herself. The percentage of assets under management is very, very widely spread too, and to me it has the most alignment of interests. And let me tell you why. So if you pay an advisor, let's say 1%, that's my standard fee, 1% of assets under management, then you have what I think is perfect alignment of interests, because I earn more if your money grows. I earn less if your capital decreases in value. So naturally, I want to grow your capital without risking too much. I want this to happen for the long run, year after year after year, no matter whether the market's going down or whether they're going up. A lot of the personal finance podcasters out there say like it's bad to have percentage of assets under management that costs a lot of money in the long run. Yes, it may cost more than a flat fee, but you have that guiding hand with you that can help you achieve your goals month after month, quarter after quarter, year after year. I've seen it a lot of times that people left to their own devices have exactly sold at the wrong time and bought when the market had gone up already big time. If you have a professional on your side with interests aligned, then you're more likely to stick through these hard times when the market crashes and you lose all hope that the market's going back up. Now, don't get me wrong, if you can get through these hard times at the market, then you should by all means go for a flat fee service that you book your financial advisor here and there whenever you need to discuss, whenever you need a second opinion or readjust your portfolio. So you got to know yourself, basically. Can you stick with it to the long term by yourself or ask for help at the right time? Or would you rather have somebody on your side the whole time? The third question is about the responsibility of your financial advisor. Is he or she a fiduciary? Now, what is a fiduciary? A fiduciary is a person that acts on behalf of another person while putting their clients' interests ahead of their own. They have a legal duty to do so and a moral and ethical obligation. So most financial advisors, this is important to know, are not fiduciaries, but they're salespeople. Just as stated earlier, you have not an alignment of interests if they're salespeople. So you gotta seek out a so-called registered investment advisor if you're in the US. Those registered investment advisors are fiduciaries by law. And they have a code of ethics and they have to act in the fiduciary role. So you really want to seek out a financial advisor that is a fiduciary. The next question, the fourth question, we're getting to the risk and return side of the R's that I mentioned in the beginning. You want to know what are their long-term returns that they have created, their track record. And it's important to get those figures after fees and after costs, after their costs and after all costs involved. And in order to really be able to compare two offers, you'll need to ask what risk was involved. And there's a couple of risk figures that should always be as low as possible, while the return obviously should always be as high as possible. For example, there is the annualized volatility of a return, of a portfolio. And there is something called the maximum drawdown, the maximum loss incurred while gaining that return that this advisor, that this portfolio has achieved. And then important fifth question is whether this track record that is shown to you, whether that's been achieved with real money in a situation that's similar to yours, or whether it is a model portfolio, meaning something that the advisor wants to do and has done research that this and this has worked in the past. That's totally fine if that advisor is new. For example, I've only started managing investment portfolios in November 2023, so I cannot have a real money track record, okay? But I have a model portfolio. But this is something that you need to ask. If you rather want to work with somebody who has 10 or 20 years or longer of track record, that's fine. Then make that an important note. So now with these 5 questions, you are equipped, and then you are not dependent on any hearsay stories and anymore that may scare you. You move beyond them, and that's empowering. That's what you want when you select a financial advisor. So just to go through them again, we've had the first R, the remuneration. How are you paid and how exactly are your fees calculated? Those are the first 2 questions. Then the second R is, are you a fiduciary? What's your responsibility towards me as a client? And then the third and the fourth R, risk and return, are questions 4 and 5. What's your long-term track record, return and risk? And was this track record achieved with real money or a model portfolio? I hope you enjoyed this video. I hope it helps you selecting a financial advisor that you need, that fits to you, that fits to your situation. I'd love for you to sign up for my weekly free newsletter, which is all centered about the power of simplicity in personal finances and investing. Please sign up to it under www.pineridgewealth.com/newsletter.